What if I told you that one of the biggest risks facing the US stock market right now isn't happening in America at all? It's happening thousands of miles away in Japan. For decades, a little known financial strategy quietly pumped billions of dollars into US stocks, helping push markets to record highs. Most investors never heard about it. Most news channels barely talked about it. But now that system is changing, and some analysts believe it could have major consequences for stocks, real estate, and even retirement accounts. So, what exactly is happening? Should investors be worried? Or is this creating one of the biggest opportunities of the decade for people who understand what's going on? Let's break it down. To understand what's happening today, we first need to understand something called the yen carry trade. Don't worry, it sounds complicated, but it's actually very simple. Imagine you could borrow money at almost 0% interest and then invest that money somewhere earning 5, 8, or even 10%. You would keep the difference as profit. Sounds like a dream, right? Well, that's essentially what large financial institutions have been doing for years. The reason this was possible is because Japan kept interest rates incredibly low for decades. In fact, at certain points, Japan even experimented with negative interest rates. That means borrowing money was practically free. Now, you might be wondering why Japan would do something like that. The answer lies in a problem called deflation. While most countries worry about inflation, where prices rise over time, Japan spent years dealing with the opposite problem. Prices weren't rising, they were falling. At first, that sounds like a good thing. After all, who doesn't want things to become cheaper? But when prices continue falling year after year, businesses make less money. Wages stagnate. Economic growth slows down. Consumers delay spending because they believe prices will be even lower tomorrow. To fight this problem, the Bank of Japan kept interest rates extremely low. Their goal was simple: make borrowing cheap, encourage spending, stimulate economic growth. And that's exactly where Wall Street saw an opportunity. Large investment firms realized they could borrow Japanese yen for almost nothing. They would then convert that money into US dollars and invest it into American assets like stocks, bonds, and real estate. This strategy became known as the yen carry trade, and for years, it worked incredibly well. Japanese lenders were happy because they issued more loans. Wall Street was happy because it gained access to cheap money. And investors were happy because more money flowing into markets generally pushes asset prices higher. Think about it this way. If hundreds of billions of dollars suddenly enter the stock market, what happens? More buyers show up, demand increases, and prices often rise. That's one reason why many analysts believe the yen carry trade quietly helped fuel market growth for years. But now things are changing. After decades of fighting deflation, Japan is finally dealing with inflation. Prices have started rising. The Japanese economy has changed, and because of that, the Bank of Japan has started changing its policies. Interest rates are rising, government bond yields are rising, and borrowing money is no longer nearly as cheap as it used to be. This may sound like a small technical detail, but it has huge implications. Remember, the entire yen carry trade depended on one thing: cheap borrowing. If borrowing costs rise, the strategy becomes less attractive. And when the strategy becomes less attractive, less money flows into global markets. This is why investors are paying close attention to Japan right now, not because they believe a crash is guaranteed, but because they understand that global money flows matter a lot. Now, here's something important. Many headlines make it sound like the stock market is about to collapse because of these changes, but that's not necessarily true. The situation is more nuanced. The issue isn't that millions of investors suddenly become sellers. The issue is that there may be fewer buyers. Imagine you're selling a house. Normally, 20 people show up wanting to buy it. Suddenly, only 10 people show up. The house may still sell, but demand is weaker. That's similar to what could happen if less money flows from Japan into US financial markets. Markets can still move higher, companies can still generate profits, the economy can still grow. But one source of buying power becomes weaker, and when liquidity decreases, markets often become more volatile. This brings us to the question everyone wants answered. Could this trigger a major market correction? The honest answer is simple. Nobody knows. Anyone. Utilities are another defensive sector. People still need electricity, water, and essential services regardless of what happens in financial markets. Some investors also look toward government bonds or gold during uncertain periods. Gold, in particular, has historically been viewed as a store of value during times of economic stress. Of course, no investment is completely risk-free. Every investment carries risk, but understanding how different assets behave in different economic environments can help investors make smarter decisions. There's also another side to this story that many people aren't talking about. What if higher interest rates are actually good for Japan? For years, many global investors ignored Japanese markets. Economic growth remained weak. Inflation was low. Investor enthusiasm was limited. But now, the situation is changing. If Japan successfully manages inflation while maintaining economic growth, Japanese assets could become more attractive. Some investors believe Japan may be entering a completely new economic chapter. Others remain skeptical. But one thing is certain. Whenever major economic trends begin shifting, opportunities often emerge. The biggest lesson from all of this isn't really about Japan, it's about understanding how the global financial system works. Money flows matter. Interest rates matter. Currencies matter. Central banks matter. The world economy is deeply interconnected. A policy change in Tokyo can impact investors in New York. A change in Japanese bond yields can influence retirement accounts across America. That's the reality of modern finance. So, is the end of the yen carry trade a threat, an opportunity, or perhaps a little bit of both? The truth is, we'll only know with time. But one thing is certain, the global economy is changing, and investors who stay informed will always be in a better position than those who ignore these shifts. If you enjoyed this video, make sure to like this video, subscribe to Wealth Decoded, and turn on notifications so you never miss future videos on investing, wealth building, and the economy. Thank you for watching, and I'll see you in the next video.